Good evening. We begin with breaking news from the aviation sector. A Kenya Airways flight bound for Kigali was forced to divert back to Nairobi this morning after two unsuccessful landing attempts in the Rwandan capital. Flight KQ-470, which departed Jomo Kenyatta International Airport at 9:15 a.m., encountered severe weather conditions on approach to Kigali International Airport, leading to a dramatic turn of events. The national carrier has confirmed the incident, citing poor visibility as the primary cause. This event raises critical questions about aviation safety protocols, weather forecasting, and the operational resilience of Kenya's flagship carrier. Tonight, we take a deep dive into what happened, why it matters, and what it means for the future of air travel in the region. I'm your host, and this is Kenya News Update today. Let's first establish the timeline of events. Flight KQ-470, an Embraer E190 aircraft with a capacity for 94 passengers, pushed back from Gate 12 at JKIA's Terminal 1A at precisely 9:00 a.m. It took off at 9:15 a.m. for the scheduled 1 hour and 15-minute flight to Kigali. Weather reports from the Kenya Meteorological Department for the morning of Sunday, February 15th, indicated scattered thunderstorms over parts of central Kenya and northern Tanzania, but conditions around Kigali were forecast as partly cloudy with a chance of morning mist. However, by the time the aircraft began its initial descent into Kigali International Airport around 10:20 a.m., a dense, unforecast fog bank had settled over the runway complex. The pilot, a veteran with over 8,500 flight hours, initiated the first landing attempt at 10:28 a.m., with visibility reportedly below the minimum required 800 meters. The pilot executed a go-around, a standard procedure where the aircraft aborts the landing, applies full power, and climbs to a safe altitude to reattempt the approach. The aircraft circled for approximately 18 minutes, burning fuel and waiting for a potential break in the weather. At 10:46 a.m., the pilot commenced a second landing attempt. This time, visibility had deteriorated further, dropping to an estimated 400 meters. Once again, the pilot was forced to execute a second go-around. Aviation regulations are strict on this point. After two failed landing attempts at the intended destination, standard operating procedures mandate that the pilot must divert to a designated alternate airport. The captain made the decision to return to Nairobi, the point of origin, which is a common and safe alternate. The aircraft, now carrying less fuel after the two aborted approaches and the extended holding pattern, began its return journey at 11:05 a.m. It landed safely back at JKIA at 12:20 p.m., concluding a flight that lasted over 3 hours but went nowhere. All 76 passengers and 6 crew members on board were safe, though undoubtedly frustrated. Kenya Airways ground staff met the flight and began the complex process of re-accommodating passengers on later services. This incident did not occur in isolation. It was part of a broader disruption for Kenya Airways on Sunday. According to a customer update released by the airline at 3 p.m., a total of 4 flights were significantly affected by adverse weather. Alongside KQ-470 to Kigali, a flight to Mauritius, KQ-274, was cancelled outright. 2 other regional flights experienced delays exceeding 2 hours. The airline stated the situation was unavoidable due to poor weather conditions that significantly reduced visibility at multiple destinations. This cluster of disruptions on a single day highlights the vulnerability of air travel to meteorological phenomena. Let's look at some numbers. In the last quarter of 2025, Kenya Airways operated a total of 8,452 scheduled flights. Of those, 147 were canceled, and 892 experienced delays of more than 15 minutes. Weather was cited as the primary cause for 38% of those cancellations and 22% of the delays. This means that on average, weather disrupts over 300 Kenya Airways flights every quarter. The financial impact is substantial. Each cancelled flight can cost an airline like KQ between 8 million and 15 million shillings in direct operational losses, passenger compensation, and lost revenue. For a carrier that reported an annual net loss of 23.2 billion shillings in its last full financial year, these recurring weather-related hits are a significant burden. Now, let's bring in our perspectives. For the safety-first argument, we turn to Captain James Mwangi, a retired pilot and aviation safety consultant. The crew of KQ-470 executed textbook procedures, Captain Mwangi states. 2 go-arounds and a diversion to a safe alternate is precisely what they are trained to do. The margin for error in low-visibility landings is 0. We must commend the pilots for prioritizing safety over schedule. The real question isn't about this flight's outcome, but about our preparedness. How accurate are our cross-border weather forecasts? Are our aircraft equipped with the latest technology, like enhanced vision systems or advanced autoland capabilities, to handle such conditions more effectively? Investing in this technology for the entire fleet, though costly at perhaps 500 million shillings per aircraft for upgrades, could prevent dozens of diversions and cancellations annually. On the other side, we have the passenger and economic impact perspective from travel analyst Wan Jiku and Joe Roje. While safety is paramount, the operational and customer experience fallout is severe, and Joe Roje argues. 76 passengers had their plans upended. Business meetings were missed, family reunions delayed, connecting flights lost. The domino effect is real. Furthermore, this incident feeds a narrative of unreliability. In a competitive regional market, where Rwanda Air and Ethiopian are aggressively expanding, passengers may think twice before booking with KQ if they perceive a higher risk of disruption. The airline's on-time performance has fluctuated between 72% and 78% over the past year. To regain full confidence, they need to push that consistently above 85%. This requires not just better weather tools, but also more robust contingency planning, like having standby aircraft or stronger interline agreements for last-minute rebooking. A third critical perspective comes from the regulatory and infrastructure angle. Engineer David Omondi from the Kenya Civil Aviation Authority, the KCAA, emphasizes systemic factors. Incidents like this are a systems issue, not just an airline issue, Omondi explains. First, regional meteorological data sharing needs to be instantaneous and seamless. A fog bank in Kigali should trigger alerts in Nairobi operations centers in real time, not after a flight is airborne. Second, we must look at airport infrastructure. Kigali International Airport is equipped with a Category 1 instrument landing system, or ILS. This allows for landings in visibility as low as 550 meters. It had a more advanced Category 3 ILS, which costs roughly 2.5 billion shillings to install. It could facilitate autoland in near-zero visibility. The economic case for such an investment across major regional hubs needs urgent discussion by the East African community's transport ministers. Let's visualize some of the data behind this debate. Looking at the comparative on-time performance for the last quarter of 2025, we see a clear picture of the challenge. Kenya Airways' main regional competitor, Rwanda Air, posted an on-time performance of 84%. Ethiopian Airlines came in at 87%. Kenya Airways, meanwhile, recorded 76%. This 8 to 11 percentage point gap represents hundreds of flights where KQ arrived later than its competitors. For a business traveler, that reliability gap is a decisive factor. Furthermore, an internal KQ report from 2024 indicated that diversions like the one we saw today cost the airline an average of 5 million shillings each in extra fuel, landing fees, and passenger handling. With an average of 15 such diversions per year, that's a direct annual cost of 75 million shillings, not including the longer-term brand damage. So what happens next for the passengers of KQ470? Under Kenya's civil aviation regulations and the airline's own conditions of carriage, passengers are entitled to care and assistance. This includes meals, refreshments, hotel accommodation if the next available flight is the following day, and transportation between the airport and the hotel. For a delay exceeding 5 hours, passengers are also entitled to monetary compensation, unless the disruption is classified as an extraordinary circumstance like severe weather, which it likely will be. Kenya Airways stated that all affected passengers were rebooked on the next available services. The next flight to Kigali was at 6 p.m., meaning some passengers faced an 8-hour delay. For those needing to travel urgently, the airline may have offered options on partner airlines, though space is often limited. This incident also casts a spotlight on the broader health of Kenya Airways. The carrier, which is 48.9% owned by the Kenyan government, is in the midst of a long-term restructuring plan. Its debt stands at over 120 billion shillings. Operational disruptions, even when caused by weather, erode customer loyalty and make financial recovery more difficult. President William Ruto's administration has reiterated its commitment to returning the airline to profitability, but that requires minimizing controllable losses. Every diverted flight is a loss. The airline's new management, appointed in late 2025, has made operational reliability a key performance indicator. They have invested in a new integrated operations control center, which became fully operational last month. This center is designed to give managers a real-time, holistic view of the entire network, allowing for quicker decisions when weather threatens. The effectiveness of this multi-million-dollar system is now being tested in real time. Looking ahead, what can be done to reduce the frequency of such events? Experts point to a multi-pronged approach. First, technological investment. Only 30% of Kenya Airways' current fleet is equipped with the latest weather radar and navigation technology that can better detect and navigate around severe weather cells. Retrofitting the entire fleet would be a capital-intensive project. Second, procedural collaboration. The East African Community's aviation safety agencies have been working on a harmonized adverse weather coordination protocol for over 2 years. Its full implementation, which would allow for preemptive cancellations or reroutes based on shared weather models, is still pending. Third, passenger communication. In the age of smartphones, passengers expect real-time updates. Kenya Airways mobile app push notifications were delayed by over 45 minutes during Sunday's disruptions, according to some passenger reports. Improving digital communication is a relatively low-cost but high-impact fix. In conclusion, the diversion of Flight KQ-470 is more than a one-off news story. It is a symptom of the complex interplay between nature, technology, economics, and regulation in modern aviation. The pilots made the correct, safety-conscious decision. The airline faced an unavoidable operational headache. The passengers endured a frustrating day. The incident serves as a stark reminder that despite our advanced technology, air travel remains at the mercy of the weather. For Kenya Airways, the path forward involves doubling down on investments that enhance resilience, better forecasting tools, more capable aircraft, and smarter operational planning. For regulators and regional governments, it underscores the need for integrated infrastructure and data sharing agreements. And for passengers, it's a reminder to always build flexibility into travel plans, especially during volatile weather seasons. The skies may be open, but they are not always clear. That's all for our deep dive tonight. Thank you for watching. Subscribe to Kenya News Update today for more in-depth reporting.